3 stocks to watch for November 2019. As I always say, please do your own research before you're investing your own money into the stock market. Also, I typically invest in mutual funds, ETFs, and index funds. With that said, single stocks do sometimes present good opportunities to buy them, but that's based on good news, great balance sheets, and positive growth outlooks. So just be careful anytime you're looking to purchase individual stocks. My 3 stocks to watch for November 2019 are all stocks with dividends, which a dividend is a payment by a company to its shareholders from the profits that they earn. So without any further, let's get into our first stock. Our first stock is Disney, ticker symbol DIS. So I'm sure you've probably heard of Disney, but to summarize their business and their business model, Disney is a diversified international family entertainment and media enterprise. They operate through the following segments: media networks, parks and resorts, studio entertainment, consumer products, and interactive media. So just going a little further into talking about Disney, I was holding this stock with a little less than a year ago when it was a $100 stock and grew to $112. I sold way too early. The stock experienced some rapid growth in the spring around April 2019, going from $115 to over $140. It has since dropped to under $130. The reason I had this stock as one to watch is that there is much excitement and opportunity over their new streaming service called Disney Plus. That releases November 12, 2019. This service has had much hype with Disney Resorts providing advertising along with ABC Network, which is owned by Disney, plugging it constantly. So there has been quite an extensive ad campaign in order to create awareness of this new streaming service that they have to offer. Disney has promised 60 to 90 million subscribers worldwide by 2024. So it's a pretty big number. It'll be interesting to see how that all plays out. Disney reports earnings November 6th, so that is coming up, and has a dividend yield of currently of 1.44%. That is paid out twice a year. So interesting that it's not a quarterly dividend, but it is semi-annual dividend that's paid out twice a year. I look forward to see how this growth dividend stock performs in the next several months as Disney Plus launches in the next 2 weeks. Disney offers a very diverse business model with many areas providing and producing consistent profits for them. So that's my first stock to watch. I don't need to go to a whole lot of detail, but I'll leave the rest of that up to you. Moving on to stock number 2, we have ticker symbol TPHD. That's the Timothy Plan High Dividend stock. So this is actually an ETF, which stands for Exchange Traded Fund, and ETFs provide for a more stable investment as these track indexes of large groups of stocks rather than individual stocks. As the name entails, this is a high dividend ETF that invests in biblically responsible companies. So you can briefly see the sectors represented in this fund as well as the specific stock holdings that make up this fund. The companies selected or screened all pay dividends, so this stock will not be exposed to as many growth stocks as other ETFs might. I find this ETF to be appealing because it does line up with my beliefs. Since this stock IPO'd in 2019, it'll be interesting to see how it tracks compared to other dividend ETFs that track the S&P or other companies that might not necessarily meet its biblical screening process that it goes through. This stock does pay a monthly dividend that varies from month to month, but this is another reason I like this stock as a way to create some more monthly income. This stock pays its dividend typically towards the middle of the month. So like I said, it does pay a monthly income, monthly dividend, and it can vary, and it varies each month depending on the month. Moving on to our last and final stock, dividend stock. once again, we have Apple Hospitality REIT. That's ticker symbol APLE. This is the 4th time that this stock has made the watch list. I am still buying this stock and expect it to drop after its ex-dividend. This is a real estate investment trust that rents buildings to hotels, and the portfolio is continuing to grow. They continue to pour money back into it, and are continuing to grow the business with more hotels, more markets across the country. I'm going to be putting out more information on real estate investment trusts in a later video, but essentially this company, like all REITs, has to redistribute 90% of its earnings to shareholders, so it's like you get to be a landlord without having to take care of any property or deal with the tenants. So that's why I like this a lot, because I do want to eventually have my own rental property, and so this allows me to do that without having to actually have anything physically, and obviously I don't have that much money right now to be able to afford that. I like this company's business model and the monthly income it produces, which is 10 cents a share for every month. So if you own one stock, you get 10 cents every month. So it's $1.20 obviously on that one stock for the entire year. I'm not necessarily as concerned about the stock's price, although that would be nice for it to go up. I like the monthly income it produces, as I've mentioned, and I've shared this before, but just so if you are looking at this stock, I currently am looking to hold my shares until it would eclipse the $17 mark. That might be a little early, but just going to get rid of a couple, and then looking to buy more under $16.15, and especially under $16. My average cost right now is about $16.65, somewhere in that range, in my portfolio, that my non-public portfolio. So that's kind of what I'm looking to do with this company. So I tried to keep this video short, hopefully informative. With the economy booming, it's my goal to start building my portfolio into dividend yielding stocks more. I hope you got something out of this. I'd love for you to comment below with your thoughts. I really appreciate that you're watching, and don't forget, I'm layman and these are my terms.